Hey, good morning. It's Luis, Alex, and Ken. It's uh, Tortoise Coaching. Let's see, March, March 15th. Ooh, the Ides of March. Here we are, 7 o'clock this morning on Sunday, and we're expecting some cold weather to roll in a little later today. I thought it was soccer weather. I was out in shorts and t-shirt all week, and now suddenly I wear my winter coat today. Crazy. Let's do a quick check-in and then we'll see what we got. And I would like today to do the um read through the weekend reports real quick while we're fresh and kind of front end that, if you don't mind. And then we'll go to individual stuff. Um, Luis, how are you doing today?
Very good, Ken and Alex. Good to see you guys. I was traveling last week, a little challenging on the execution front with limited technology resources. Very
Yeah.
interesting week with the Iran war and here in Austin, seeing what's going to happen with this trade and also interesting to see how there's been a little bit of a market change behavior. We all know about a certain institution that used to create some spikes, downward spikes at 10 in the morning. They were famous for doing that.
Hmm.
They were calling it they were calling it tipping the candy jar to
Yeah.
get their hands on the candy, and they've been caught, and that has stopped a little bit.
Yeah.
That's it.
That's a good thing. That's a good thing, I think.
It should be a good thing, but in the meantime, there's been a little bit of a behavior change in some of the shares.
Yeah.
They're going to have to come up with new ways to get their hands in the pot.
They'll find some way. They always do.
Right.
Alex, how are you doing this morning?
Thank you. I'm doing well. I'm working through my trades. This week my conservative account was behaving, ended up better than my trading account. So I'm looking to two ways to analyze that.
Well, mathematically, it should do that. Otherwise, we would never use it, except when we're traveling for more than a day, So, all right. Well, I thought this week we'd just start with the weekend reports and kind of make that, if it works, we'll do that sort of as our ritual and entry into the sessions. So, with your permission, um, and then we can cover whatever materials you're bringing. So, this is the weekend report, March 14th. I'm noticing sideways volatile. We've come all the way back. Prices come here and it's come all the way back to the 200, within 2% of the 200-day moving average. So that makes it automatically uh, ideal short-term intraday trading because the market's sideways. It doesn't have a bias. And then the volatility means it has a bias to want to go long or short in big ways with no follow through. So that's cool. Um, Reinforced with the short term performance, 30-day, 10-day, 2-day is all down, wicked down, single digits. The 90 has decayed to underneath the midpoint, but the long term has been still kind of exceptionally strong. No change to the holdings. And just notice all international and energy and materials, those been doing pretty well. And Australia is commodity based, so that's not been bad. Leaning forward, it still looks like all the same, that same orientation mid-month. I like to check on that on my long term just to see how we're doing. Over here on the market mosaic, still risk off, and the risk Z is abnormally down. So this tells you, it's not surprising that this volatility is reinforced by that volatility. Um, when you look at the Z score of this, when it gets above one and below one, so this was a good long swing. There was some short-term goodness intraday there because of volatility rising. This was actually a favorable, some long-term swings as markets were improving. Um, but also, after a period of this kind of down volatility, the reversal doesn't mean that prices are just going up. It is also that the volatility is starting to decay and it's getting smaller. It may or may not be directional. So we got to remember this is not purely a directionality score. This one, however, we were seeing markets rolling over and price decay. It got to this kind of critical state around -1. It even had a couple times when it tried to recover, but it didn't. It broke big to the downside, and this corresponds with the dang Iran war. The ETF2 theoretical exposure has been to this kind of reacting to this volatility, uh, and the big global indexes have started to move below their 4-month moving average. So if this is the 200 that just got here this week, as this thing started falling, there's the 4-month moving average. So 4 months is 22 days a month. So that turns out to be about an 88-day moving average. And so this one would have been like this. And now enough of the 10 global indexes from ETF2 have now moved below their 4-month moving average to make them go so that 8 out of 10 are below that moving average. So that causes ETF2 to reduce the exposure for overnight heat for any new money. With that, the way that system worked was it was much like the BMR. You would initiate either a 2 ATR or a 10% trail, and then you would try to hold these winners, and it would usually be, out of this population. You're trying to hold those as a swing because of their relative strength, and then you have something like either a 10% or a 2 ATR trail stop. But then when those stops are honored and hit, that when it exits, that money goes into the cash portion of ETF2. And then you wonder, can I put that money to work? That's where you consult this number. And it says, so on your ledger, you have something like cash over here. And then you have actually, your trade positions over here. And so I might have, let's imagine a day where I had 5 things in, and I might have had 60% of my portfolio deployed and 40% in cash. And then let's say two of the weakest ones during a sell-off would come down and take their exit, then those positions would be closed. And then that money would move over into the cash. So now I might have about 60 and 40 as my relative exposure in the market because these positions in ETF2 were intended to be somewhere around 10% of the cash or 10% of the account deployed into that position. So if I had five, if I had five, I'd be, no, I'm sorry, if I had six. If I had six, I'd be approximately 60-40. If two of them were hit, then those monies would go to cash and be about 40-60. And then I'm wondering, okay, can I put that cash to work? that's where I would go look at the weekly allocation and say, no, in this kind of a market that's featuring this kind of volatility or weakness of this is weakness of price, I should say, this kind of volatility and this kind of volatility for risk Z, and I'm only at 20%. Well, number one, that system's rules are doing what it's supposed to do, which is to put a limit on how much exposure I'm going to have because of all that uncertainty. It still allows me to trade. It allows me to maintain the positions that I have, which are protected by the stop, which was appropriate for holding overnight because it's a 10% or a 2 ATR trail. So if there's still room in that exit for that to stay active, then we just respect the stop because it's supposed to protect us from the kind of risks that we see here. So I don't use this number as a way to preemptively eliminate those trades because if those things are in energy, Latin America, um, Australia, and materials like they're supposed to, they may very well be working and making money. And so I don't want to use my portfolio heat governor to prematurely exit a position that's performing to standard. What this number does here is allow me to check my cash position to determine if I should put more money into that system. Does that make sense? Yeah. So now if I am at the current position at 20%, I could come over here and look and say, well, I still have four positions, so my exposure is 40, my cash is 60. That prevents me from putting a new position on in that in that environment. So that's what I want to say there. That makes sense?
Yeah, yes.
Yes, it does.
Okay. And then just the final check. This portion of the risk Z, uh, this is just a running score. So we're below 1.5 on our way to 2. So this is really that little red box represents a significant abnormality. So the market is essentially taking the Iran war much more seriously as it feels like it's slipping out of control with Trump begging for other nations to suddenly come in and help secure the straits. That's the kind of thing that you can do with allies when you cultivate them, uh, rather than threaten to attack them and leave the alliance. And then suddenly, when you need them, it makes it a little more difficult. And who could have known that that would be the case? You know. All right, let's. That's what I want to say on page one. We all good there?
Um, may I ask you a question?
Oh, sure.
Um,
Yep.
so under ETF theoretical exposure,
Yeah.
when your position getting close to hitting the stop, you don't,
Yeah, I would think of doing that. It's like if I got within one ATR,
mhm,
like if I'm over halfway back,
mhm.
I'll just take it.
You'll just exit.
Yeah, because if it's already falling, it's not one of those defensive plays that are doing well anyway.
Mhm,
And now as it's getting close to, it's moved half the way towards the stop. I now start worrying in a swing trade
mhm,
about 1 day adverse reactions. And so to reduce that risk, I would strongly get out and then document the mechanical rule set of ETF2 doesn't say that, but I'll do that at age 68.
mhm.
And
Right.
so your mileage may vary.
Good. Thank you.
Yeah. All right. So this one is the regression line fractal framework. It's a daily chart. Oh, I forgot. I was going to put Canada in there, but I didn't. So this has the price, and then I'm using the MACD histogram. That is a 430. And then this is the Red River in here. The Red River is a 30 period Bollinger Band with plus or minus one standard deviation. And it's built off of it's reading the blue line, which is the MACD signal line. And then the signal line is being trailed by a 5 period moving average. That's this little pink one. And so what I use that for essentially is to find confirmation of the spring condition. Like this is clearly winter, so we should be short. Yeah, we should be short. This is where that boundary occurs, and we can be long in the spring till it gets into once it gets into the Red River, this is the region that's kind of normal. So when I see that kind of a move, that tells you that lurch to the south is really an abnormal move. And because this is the MACD 430, what it's doing is treating a fast moving average of the RL, it's using the RL10. It's using a fast moving average of the RL10 and a slow uh, moving average of the RL10 to create the moving average convergence divergence. And that allows us to kind of identify this as a opportunity to really be short intraday. It crosses over when it crosses over its little signal line. This is kind of I want you to notice that blue circle was drawn because if I take the slope of this MACD, if it was going to continue to get bad, it should go like this. But that line actually is slowing down, and it's warning me that this might be the time when it reverses. And then if it reverses enough to cross the 5 period moving average of itself, it says that's a demarcation. The sell off is over. There may be an opportunity for market reversals. Oh, yeah, I guess there is. And then I want you to notice this is the moving RL 270. And then this is the moving RL 90. And this black line is the 30. And the blue line is the 10. The SMA, the middle of the river is this dashed line. That's the BB30. Or I'm sorry, the MA30. And then this little guy in here is the dragon, the little pink dragon. That's the dragon. That's the 10 period SMA plus or minus a half. So if I were going to draw the 10, it'd be in there. But that gives you the width of the dragon. So what this is reflecting then is I'm looking at the 4 regression line fractals. So this is the long-term buy and hold is the 270, has the 90, the 30, and the 10. So this is long-term buy and hold. This is the trader's price. That's the smoothed, fair price of the trade. That's this blue line. And I'm kind of watching for the peaks and valleys. So it's in the regression line fractal framework. The difference between these two is the difference between long-term buy and holders, their fair value, and then the trader's price. So when price had been going up and it got up in here, there was a big difference between the trader's value and the long-term buy and holders value. And then the recovery comes back and finds support. This great big boundary, this is a safety band right in here. And that one is a 30 period Bollinger Band, and it's taken on the 270. So the 270 regression line creates, and if you put the Bollinger Band on it, it creates like a boundary of safety. So here's where that thing price came back and crossed the 270, but the boundary of safety would have been the bottom of this. So it can dip in here a little bit. It's starting to be a concern, but it hasn't broken yet. Now, the thing to notice is that the 90 is the next slower thing. The fact that this is above the 270 means that we have a bullish optimism. This big circle is where that 90 crosses the 270. So that says warning. So you have the price starting to slow down and oscillate. You can see the gap between between the 90 and the 270. It's slowing down. What it should have been doing, if the trend was going to be strong, this trend was going to be strong, is that thing should have continued to go like this to be parallel to the 270. And as long as that price were to be going up and this much space, then that acts like a buffer between the 90 and the 270. But price had decayed enough that the 270 rolled over, and when the 90 rolled over. So when the 90 comes back, this becomes a test location. And you can see it has the first test it held, second test, warning, and now it's making it made a high with the RL10, a high with the RL10, but now it made a lower high. Uh, Here's where the 30 crossed the 90. Here's the 30 comes back up and it can't break back through, or the 10 can't break through. So now you can feel the 90 rolling over. So now, as we speak today, there's the 90, there's the 270, there's the 30, and there's the 10. That's a complete inversion and rollover of the market. And now you can see the distance between traders' price and long-term fair value of the market. You can see the traders have been cutting and running at least since here, certainly since here, and now this is just this chop. Now notice how we're getting these are every place where the RL10 has rolled over and made a new low, the bottom of its peaks, and then its higher peaks are also rolling over. So that's telling you this market is turning. The longer term guys have just started to notice. Because if you were to take the RL 270 and extend this thing, it would be going like that. But it's actually starting to roll over and it's getting closer to its own little buffer here. And then when the 270 rolls over, that's when those guys go into protection mode, right? So this move right here has been is about 5%. So if we go to the peak, this peak up in here was right around 700. So 10% is 70. So 5% is minus 35. So a 5% sell off from here would be 665. And if we come down here and look, there's 665. So this move from here to there is now minus 5%. Now that's a significant number because that's between 2 and 3 ATR from the peak. So we would expect all those long-term trades to be hitting their trailing stop. And in fact, in ETF2, we see that because it's gone down to 20%. In this kind of a market, it's suggesting you should only have about 20% of your money in ETF2, which is trying to go long. So that's sort of a preventive medicine, if I can say it that way. So this was a peak to the downside of the RL10. That's where it turned. Then when it rolls over, here's where now this time it was better. It started to make the recovery. It didn't come all the way through the SMA 30. This is a Kata 2 formation, and you're expecting this thing to go. And to be confirmed that it goes, it has to get above this. It did for a minute, but then failed. The RL30 was here, and to try it again, it got a little bit above that, but no follow through. By this, I look at these as like 3 failed attempts to go long. That was enough for the 90 to come back over and cross the 270. So when this one failed, that's one that tells you things are different. And if you look at this, you got a rising wedge. Now, now you're getting this. This looks like the jaw to me. That looks like the jaws of a dragon that's looking to eat them up. That's what that looks like to me. And then if we just notice where the RL10 comes to a point, this one was kind of key. When you say those three together, price should be trying to do this. It took longer to do that here than it did here. So it took longer, and then it only got as far as the 90, which is also rolling over. And then the RL10 peaks here. And now this one breaks below that one. That's a warning. And then when that one breaks, this one says, dude, you definitely better be short. When I come down and check here, the same place that this collapsing dragon occurs, this came out of the Red River and broke below the zero line, and we're heavily into winter again. And sure as Shinola. Yeah, so there were on the red, when we look over here in the Red River, this is where things are okay. It's staying within the normal bounds of the Red River. It was even trying to peek its way out of there. And that's where it failed. Comes back in the Red River, and then it crosses, it comes back outside of the Red River and tests the Bollinger, or tests the zero line. This is a warning. It could not break out here. That's a warning. It comes out of the Red River. And now, this whole period of time is short side is favored. It's warning you that it's the faster moving price is leaving the slower moving price behind, and it's getting weak. And then here's the second time it comes out of the Red River, and now it's gathering momentum. And so I come back and look at this and say, this is just a 5% sell off. The official correction is if it drops 10%. So if I take 660 or 665 minus 35, 630 is going to be the downside. This is 650. So 630, there's another chunk this big for the market to come down to 630. That would be the official start of a correction. And I'm going to tell you this, because of accelerated trading and algorithms, 5% is kind of an unofficial correction. And there were a bunch of guys who would start taking action at 10% sell off. Those guys are taking an action at 5%. So now it turns out that when 5 and 10 was the standard, like this was the warning and this was the alert of a correction, I think it's now 2.5% and 5%. This is like 1.5 ATRs. And so this is to me a strong warning that a bunch of aggressive traders are looking to push to 630. and it's already, all it has to do is beat this. That's the last piece of price support that's visible for a long period of time. So if this cracks, that's next. Check or hold.
Check.
Check, understood.
So when I talk about market classification, there's we're still in market classification right now. When I come back and look at these, this was all those other measures, snapshots. There's a time series in here. There's a bit of a time series on the NDX, but it's the volatility and it's the early warning system of the catastrophe prevention model of ETF2, which updates weekly. That's what I'm taking off page one. What I'm taking off of page two is sort of the tactical price action of SPY using a mixture of a couple indicators, like the 30 simple moving average. That's the middle of the river. To keep this from being too cluttered, I've taken off the plus and minus Z's. It turns out this is a this is a Z3. And then I'm using that MACD to feel. What I'm doing here is I'm trying to feel the flow and how far. I look at it as like a tug of war. Here's time, but it's a tug of war between the bulls and the bears. And so if the SMA 30 is the zero line of the last 30 days, then I'm always looking compared to the middle of the river, how far were the bulls able to pull that away? And as long as that's getting pulled farther and farther away, that means price is leaving the 30 behind. The 30 will start to follow it, but as long as there's this boundary going up, that's okay. But then when price comes back into the river, crosses the 30, now we're on the other side of the river. And now I can start looking back to see where are the support levels that when they break, it's warning me that this rollover is now happening. So that's how I'm using this to assess the relative strength. Hey, they were able to pull it all the way back to the 90, but they couldn't go any further. And now it came back to the 270 and SMA 30. Gets only back to the 90, only to the 90, only to the 90. Uh-oh, starting to fail below the 90, and now the 90's rolling over. And you can even see the SMA 30 is lower than the 90. And here's the dragon lower than the 90. And here's the price lower than the 90. So you can kind of feel this. I feel that like an open hand, and each of my fingers are kind of each demographic has different levels of anxiety. They were all together right here. This was the moment of maximum uncertainty about which direction it was going to go. They all agreed that that was the fair value because that's a super pinch because the 270, the 90, the 30, and the 10 are all right here. And now we're going to see the traders are the first guys out of the stack, out of that mess. So if I say this is that's the that's the range of uncertainty. As soon as that breaks, I'm looking for this or I'm looking for that. When it breaks this little buffer right here, that's a signal that I should be double short. So from an orientation, that's where it's. So notice how that whole pile is leaving the buffer zone, whereas when things were good, it was above the buffer zone. That's what makes this that transition point. And this is the super pinch. This is like a giant acorn. And we're going to see a tree moving that way in through the underground. So I'm trying to capture something like the feel of what I'm using this one for. Um, this is like when I'm watching my soccer players and I'm trying to decide when is it time to substitute them because they made three or four long runs on the offense, and they're starting to get tired because they can't push it higher, and the other team is catching up, and now it's this side. So this is where I fully expect different symbols to be leading the way. And if you think back to the ETF2 in the BMR candidates, that's showing you where the strength is or the things that are losing less. All right, I probably beat this thing to death, so that's what I wanted to say. Any questions on that?
Yes. So if I
Whoops.
understand it correctly,
Yep.
by their beginning of February, it looks like their
Yeah. Yep.
things started to turn south. They're
For sure. Yep.
30 10 and they left 90 downwards.
Yeah.
Right
Yeah.
over here. Good.
Yeah.
Got it.
When all
Thank
when all of that stuff, it's if like Occam's razor, that RL 270 is the long term buy and holders. They're starting to wait. You can see that rolling over. They're starting to wake up too.
you. Mhm.
But it took this much of a wake. That's a 5% wake up call. So that means these guys are starting to say, okay, frame it. Okay, the 10% sell off is here at 635 or 630. So that's how much wiggle room. That's the safety buffer of these guys.
Mhm. And those long-term buy holders, it's like 401k people with 401ks and
Yeah. Yeah. At 10%, the aggressive long term holders are starting to hedge and pull back positions. And if you think about it, hedge funds that are out there at 10% from the highest high, that's when they pull their money out of hedge funds.
Mhm.
They're more aggressive than long term buy and holders. But this is now the people that are managing long term money aggressively are starting to think about are making plans for how to protect. They can't be jockeying around at a 5%, but at 5% they wake up, and at 10% they're acting. So this is the last little bit of uncertainty and protection. At 10%, at so 630, if 630 gets breached, that's where it's like, okay, the Iran war could start looking as bad as COVID. Because if you think about 5 warning, 10 correction, 20 bear market. So we're right in this position now with a little bit of buffer to 10, and then the long-term buy and holders have a buffer at 20, they
Mhm.
collapse. And then in all of the great big market sell-offs, that's gone down anywhere from 40 to 70%. COVID went 40. So we're at -5. Nothing to worry about except that. So that favors the short-term trader, the guy who can take advantage of 1 day short day pops. So I am typically intraday short and not overnight short. I don't mind being long things like energy and gold, but I'm not taking swings short because of you get gaps like this.
Mhm.
And so the intraday reliability of volatility is great enough to I just pull my horns back in and I let the swing trades that I have take care of themselves. But that money that's not going into swing trades, that 50% reduction to 20%, that's money that I roll into the short term trading,
Mhm.
so that I'm not, so I have something like a compound capital between swing trading and short and intraday trading. And then the long term stuff takes care of itself. All right, that's what I wanted to say about that. I'm gonna go start going through this other stuff a little more quickly, so to give you guys stuff. I have to be rolling out of here in about an hour. So anyway, this one is the I'm looking now at the 3-day and the 9-day moves. So this is still using that I'm looking at 3 days chart, 3-day bars, and the 9-day bars. This feels like the jumpier, shorter, faster. This is the slower. Just as a demarcation, this was the end of this was Biden. Trump takes over. This was the Trump dump. And this is where it crawled out of the gutter. Here's where the now when that's the 10 period moving average crossing the SMA 30, but using 9 bars. So that's a 10 period MA on a 9-day bar is equal to the 90, the RL90 on a 1-day bar. And that really, to me, is the health of the market. So that's why the 90 is um, the 90-day moving regression is pretty good. And that is reflected on as the RL10 here, the Trump dump. And now this line, this is where that becomes. So this is like a kata 2 in here, and this is the emerging dragon. And so the emerging dragon came out of this thing at 600. So this is the fair value or the extra boost that comes from that emerging dragon. And then right about here, you start seeing the first penetration of the lower skin of the dragon. That lower skin of the dragon comes up in here. That breached right there. And now you can see the RL10 PSAR and the RL30 PSAR hitting. So all this is a warning here around 635 that the downside back. So 635, if that's 700, this is 635. That's your 10% sell off. And this one is about a 15%. Coming from 700 to 600 is 15%. That would make this about a 20%. So that's the price that would trigger, in traditional terms, a bear market. But to me, we saw from our first page, this is already sideways volatile, ready to start collapsing. So my indicators are giving me the warning signals about how bad is this thing going to get. As long as it kind of, if it finds a reversal above 10%, then the long-term buy and holders are coming in to buy this here just like they bought it here. And after this, we got that. And it was official when it crossed above the previous peak. So with that in mind, now I'm building the frame to the upside. If this is the peak of the RL10 to the upside, that's at price approximately 700. And price has come back to 665. So if this holds, this is Kata 2 territory. This would be emerging dragon territory. So what I can already do is I could just put some trades in to buy this market long in technology, like buy XLK if SPY goes above 700. I can put that trade in now and then be surprised into it. So this is going to be tactical trade. If it reverses, This will be tactical trading on the long side. And then this would be massive deployment to the short side with the short-term trading to take advantage of moves that go like this all the way down to here. And that's how fast price got ahead of its RL 90. That's how bad that got. And then when it recovered, that was enough to turn it around here. And then that was enough of a warning to be ready on the long side in case you get that. So I consider these to be my um, um, standard interpretation of the RLFF. And I'm looking at smoother look at these longer term trends, 3-day using 3-day and 9-day bars. And then I'm using this as a point of comparison so I get more of a tactical look and then just a smooth rolling look. Okay. Questions on that one? Is this doing okay for you?
Thank you, clear. Yeah.
Yes, sir.
Okay. So now I'm zooming closer and closer. Now I'm looking at the last 150 days of the market. Now I'm in sniper territory. Now it might be a little confusing, but I'm still using that same pink color for the longer term. I've just tightened it up. So this is now the RL 150. On previous charts, I was using the 270, but because I'm in my sniper mode, I'm using the 150, the 30-day, and now the 10-day. Because I need to see 2 out of 3 of those in an unusual position. Like this was useful because it went from that extreme. It's the RL 150 is now right around, looks like around 65 or 70. If I say this was the peak, because it is, that's the 150 period NDX. So that's about, maybe that's 70 and this is about 30. So if this is the 50-yard line here, that's correction territory. That's around that's around 650. All right. So this is the 150, this is the 30, this is the 10. Now, notice the volatility of the 30-day box compared to the 150-day box. Um, it's now a significant percentage of a time period that's 5 times longer. So there's 5 30-day boxes in this thing, something like that. And so this is about anywhere from a third to a half is the normal volatility of the 30, which means that the longer you go back, the less volatility there was, and it's more directionality. But as you start getting into sideways volatile markets, the size of that 30-day box gets large. And here's where you could see that's where that big rollover occurred, start of February. Now, here's the 10 period. Now, look how volatile a 10-day period is compared to a 30-day period. That's why, to me, the 10-day period is the ideal reference point to understand the current swing choppiness of the last 10 days. The fact that this is so large compared to the 30 tells me that the daily volatility, the size of the daily bar, is getting bigger. which means the intraday moves are getting larger, which means it's easier to trade intraday than it is on a swing because the intraday moves are large, but there's less and less follow through. And so that allows, and then the ETF2 system is reducing the exposure to swing trades and making more capital available for intraday short term trades. Do you see the relationship between those systems? That's in helping to inform my asset allocation between systems. So price is now has come down to the 150 and it's on the wrong side of it. This is an extension of the SMA 30. So if I'm going to color in the SMA 30 in black right here, that's the middle of the river. And you can see how that rascal has rolled over. If I take the last 2 points on that line and just do a straight line projection, that is the current slope of the SMA 30. That's where the river's heading until enough buyers come in. You got to see some buyers come in at these prices to make that thing turn. And then if price turns, then the RL10 turns, and then the SMA 30 will start to slowly turn. So uh so if the SMA 30, let me get my line in here. Let me draw this in red. So if I should have done this in red. So that's where the projection of the SMA 30 is. And price is right here. So that means guys got to come in and start buying that and drive it up. This would be the reversion to the mean trade, the back to the middle of the projected river. This is the return to the actual river. If they turn it around and start buying it, then price is going to meet a river, and then wherever that hits, then it might be getting to the far side of the river, and then that's the breakout from the river, and then here's the breakout above the previous peak of the RL10, so it's got to get above 700. So this is all tactical trading inside here, one day at a time. And hopefully I can hold some stuff overnight if I have earned money in the direction of the slope of the river. Check or hold? Okay on that?
So
Now I'm zooming in on the RL on the last 30 days. This is still a daily. Here's your boundaries of the 30. This is the boundary of the 10. Like here's the 10-day slice. This is day 6 to 10 in the blue. This is day 2 to day 5 in the red. And then this was that little 1 day projection. So that's 1 day. That's days 2 to 5. This is days 6 to 10. And you can see that was quite a range and everything's rolling down. This is the size of the yellow zone going into tomorrow. Price is the black line. It's right near that 30-day low. If that breaks, I'm so short that you can't stand it. It has to get above this for a mechanical entry. This is such a wide move that if it just opens inside the yellow zone and starts moving, I can make an intraday trade just inside the yellow zone. And then I'm looking for mechanical swing style entries 1 day at a time if it breaks above the green. But if it breaks below the red, then my bias is short side. Check or hold.
Check.
Now I'm going to check the RLs. There's your RL10. There's your RL30 extension. Oh, I'm sorry. Here's your 30. No, this is the average volume weighted 30. Look how far price has pulled away. Here's the volume weighted average price of 10. Here's the volume average weighted price of 3. So it's below all those VWAPs. This price was a deadly close. That was maximum fear being expressed over a weekend because of the idiots in the administration and a war. That's a sign of panic. That's the kind of day Friday was for intraday trading. This is the 30 period or 30-minute bars. And this is where I look for those peaks and valleys as turning points. So when this breaks, that move is key. When that can't go any further and I get the reversal, I can go from here to here itself, right? So Home Depot is going to become a value opportunity here. And it's getting slaughtered much more than its counterparts. That's that. So this is a comparison, this red, yellow, white, green comparison is the statistical differences between these just among this population. So interestingly, Nvidia is doing well compared to Home Depot. So you wouldn't expect that, but that kind of anomaly is what makes it a market. Okay. Moving on. This one looks at all to 183 liquid enough ETFs. The top chunk is the ones that are really outperforming. And inside that, I'm looking for all green across the board is the superstars that have not started to crack yet. But the things that are in the red and yellow are starting to break and collapse. That could be a buy on dip opportunity like silver, South Korea, and gold miners. Or maybe that larger run is done. I don't know, but they're certainly in play. And then the ones at the bottom are kind of like those are like the little catfish that are just the worst possible ETFs out of the last 100 and, last 6 months. And I'm looking for signs of a turnaround inside there. So natural gas is of interest. Um, India. Financials are just, you can see how bad XLF is. It's 177 out of 183. Are we going to run out of large banks anytime soon? No. Is that an automatic setup and frame? Yes.
Hmm.
XLF has to be on the radar. This one is the regional ETF2s, market classification, and a quick look at the regions of the world. So these are the 10 symbols in ETF2. You'll notice that all 10 of these are also in BMR 13, but these are really big, broad uh, regional sectors. Two of them are above their 4-month moving average. Those two create that 20%. 8 of them are below. It signals as cash on the moving average filter. That's why we're at 80. Last week we were 50-50. 3 more symbols got weak. Check or hold?
Yep, yep, understood. Now
Yep.
this is the source for the box on the page one.
Yeah.
Yeah.
Yep.
No, yeah, yeah.
And then this is so now I'm looking at these are the um ETF2 categories. I look at current strength, 10-week moving average of strength, and then this is a system quality number, and then these are all built from 0 to 100. So I take all of the 183 ETFs, and the best performer gets 100, the worst performer gets 100, and that gets indexed and then that's the number that you see, and then I color code that green, white, yellow, red. So, and that's plus or minus one standard deviation. So the ones that are in green is this is essentially the top 1/6, bottom 1/6, then in the middle 1/3 and 1/3. So anything that's in green automatically stands out. Anything that's red really stands out. And so as you can see on this one now, energy is just extraordinary. Finance is getting obliterated. Industrials and utilities are in second place. And then yellow is the lower from half to one to minus 1/3. And then you can see also that the moving average signals. Yep. And then just as since I usually go from this chart to go look at a price chart, I just remember what the ATR is. And then the ATR percentage gives me a quick look on relative volatility. And then so now I feel like I have a quick look at the US and the S&P. And then what I'm looking at is I come down here to the broad asset class. There's the S&P against treasuries, real estate, blended commodities, gold, and oil. That's sort of the widest possible asset class consideration outside of just common stocks, real estate, commodities, treasuries, just as the broadest differentiation. And you can see right now, commodities, gold, and oil compared to the S&P 500. So I find that to be handy. Then on the right-hand side is a geographical array of if I take the US stock market and break it into large, medium, and small caps, and then value, blend, and growth. That's the Morningstar style box. These ETFs represent those portions of that box. They're all underwater. What's
Mhm.
working is so then I go to look at Latin America and emerging markets, and then Canada, Mexico, Brazil. So if that's North America, actually kind of if that's the US, this is Mexico and South America. This is Asia over here. This is Japan and Asia less Japan. Then these are individual countries. This is Europe, and then this is countries in Europe I care about. And then this is uh non-country. That's oil, gold, silver, treasuries, corporate bonds, US real estate, that kind of shit. So what I'm getting now is sort of I see that as the globe. Is the money moving between regions? Well, right now it's moving out of the US to Latin America and commodities. That's like we sort of already knew that, but that's my shorthand to double check.
Mhm. So if I'm look at this at the right side of the page,
Yep.
it tells that the like a world as a whole,
Yeah.
as country-wise, is getting weaker.
Yeah. Well,
Is
it's the
that
weather
right
map. Yep.
assessment?
I think that's fair because money is actually moving out of the countries
Hmm.
and moving up into here.
Hmm.
So that's commodities, gold, silver, oil, treasuries. That's money leaving the equity markets.
Hmm.
And so everything's going down together.
Hmm.
Instead of sector rotation, money is leaving the equities.
Hmm.
Right. So this one now is using that same kind of table, but this is taking a look at this is about the most liquid 100 of those 183,
Hmm.
certainly tradable. And then it categorizes, I'm looking at by current strength and 10-week average of strength. And so there's green, white, yellow, and red. So this is about 1/3. Yeah, my mouse is acting shitty.
If I
There it
may ask a
is.
technical question,
Yeah.
Luis, do you see there like a black bar on the left, or just on my screen? I've
It's
seen
No,
on a two
I
different computers
yes, I'm getting a black bar on the left and a black bar on the top right too, a
on
black
the top
square
right.
let me try
rectangle.
that. Is that Yeah, that's showing that's where I'm sure on my screen, but your video is on there,
Uh-huh.
or the video that shows your face, so it may
Uh-huh.
be blacking that out. Let me try to move that off. Let me see if that works. Are
Okay.
they gone?
Yes. Yeah. So right now
Yeah,
the
they're
bar
gone.
on the left disappeared. Yeah. Uh-huh.
Yes, they're gone.
They're gone.
Okay.
Okay.
All right. Oh, okay. I can actually move that. So that's the administrative boxes,
Mhm.
presume. I can move that to the other screen. I didn't know that. Okay.
Okay. Yep. Yep. That's much clearer now.
Okay.
Thank
So
you.
now what I have, so when I take that group of 180 and apply the stat, that's the average score of between 0 to 100 from these columns, strength, consistency, and quality. Then those are added and averaged, and that's how you get the average score. It is sorted by the current strength. That's like that's a blended 10-week moving average. The consistency is a 10-week average of that average. And then the quality is a system quality number. All of it indexed 0 to 100, and then categorized green, white, yellow, and red. So this is about 1/6. This is about 1/6. This is about 1/3. And yellow is about 1/3. So that gives you a rough proportion. So green good, red bad. And now what I'm doing is I identified uh there's like 10 different combinations in here. Uh I like green and white because it was good and now it's great, so I can exploit new strength. It's new leaders. Green is good because it was great, it's still great. I can reinforce trend following. Winners are continuing to win. Red losers. Red yellow is was bad, now horrible. Great short candidate. White yellow, it was weak on consistency and now has moved up to white, so it's starting to move to the front of the pack. And so similarly, green and white was good, now great. White yellow was weak, now good. Yellow red was bad, now it's just weak. That's how you can see the progression of things rotating inside the cooking pot. So green and white leads me to look at energy. White yellow leads me to look at utilities and sector spiders. So that's not surprising. And then the ones that are green, even though they're volatile, silver of any type, and oil and South Korea, but very, very volatile. So I like green and white because there's no topping action yet. It's early stages. So if I was thinking of this as a time series, I look at the main body as in the white and the yellow, above average, below average. That's the pack. These guys have fallen out of the pack in red, and they're just terrible. And then the green guys, the front runners. So when I see green and white, that's a guy that was in the pack that just moved up into the front runners. The guys that are green and green are up in here, but they already may be exhausted. And if they start collapsing like South Korea and silver did a little bit this week, they could be falling back. It could go green, green, and then white, green as they come back into the pack. So I like to see the ones that are, they were good enough to be above average for the last 10 weeks, and this week moved into the green. I kind of like that. Emerging leaders. That makes sense?
Okay.
Right.
So the green a continuation pattern,
Yep.
and then this was an acceleration.
Yep.
Okay.
So for my longer term, I can't wait once a month and just follow the rules of the BMR. I want to start seeing how those candidates are shaping and moving once they get, and then they'll get to their monthly rebalancing, and then I can check it out. All right. So this one just shows the top 30 ETFs by average daily dollar volume, and it shows their ATR percentage. So all I'm checking here is of the most liquid symbols, the ones that are the easiest to trade intraday, silver, semiconductors, and gold, emerging markets in South Korea. Look at that, 7% in South Korea. Wow. 6.5% in oil, and Brazil, and then regional banks. So that's just based on average daily dollar volume. The Qs have caught up to the S&P. People are playing the Qs hard in this sell-off. That's what that means. This is the most liquid, probably 50. So you can see this is all sorted by the strength column: green, white, yellow. And then page 2 is the red. I summarize that. That's the same chart that I use where I just put it all on one page. So this one just gives you a wider reference. And these are all based on they met a minimum threshold of daily dollars, and that gives you just that relative ranking. So that takes us through the weekly, and we're getting ready to go into the daily. So I want to stop there and see if there's any questions on the weekly lineup.
Mhm.
So
Okay.
that's what I look at over the weekend to kind of get my head wrapped around. And I think that I could, if I do that once a week, I can feel my way through the week ahead by remembering what the larger moving trends are. That's going to
Mhm.
last about a week. I will get some reminders of what's going on daily. I mean, I'll still be able to see that, but I like to get that fresh once a week, kind of a bit of a deep step back and look at the wider picture. And everything from this point forward is more like the intraday tactical trade. Does that make sense?
Mhm. Yes.
Yeah.
If I may ask for the for those that are 180 ETFs,
Yeah.
uh, do you have a like a list of them that's available, or
Yeah.
it's
Yeah.
somewhere?
I'll shoot you that list.
Okay, thank
Um, it's just that some of about the bottom, they're the most liquid,
you. Hmm.
uh, but not all of the ones that are on that list are liquid enough for intraday trading. They're
Hmm.
liquid enough for like swing trading, but most of them are not liquid enough to
Mm.
for the intraday. That's why I have that reduced set.
Got it. Yeah. Yeah.
Yeah,
I'm on the other side. I'm looking for either swing or position.
yeah,
Um,
yeah. I'll shoot you the longer term list.
Thank
Um, so now this you've seen this a lot. So and I have us at 8:35, and I got to leave in about 15 minutes. Um, let me. I would like to just hit the swing trade of there are a couple tactical trades in there. So this is the one for tomorrow. This is XLP. XLP is the one for tomorrow because um, the 1 day swing trade value, XLP, had the greatest number. The other ones that are still really good, and again, anytime you see me using this green, white, yellow, red, this is the top 1/6 based on the statistics of everything that's on that short-term trading list. These are the ones that really stand out. So anything on this list could be traded one day. I just am framing, I'm making a habit now of just framing the one that is the most extreme as an example of how to frame any of those. Any of these ones that you look at are going to have approximately the following feature. So this is XLP. These are daily charts. So the yellow box is yesterday's price. So that would be the mechanical long, mechanical short. Here's your peak of the RL10 recently. The RL10 actually bottomed here and it started to reverse on the basis of this little gap up and go. So there you are. So what I did was I took this rule of four. I said, here was the bottom, here was the top, there's halfway, there's a quarter, and there's a quarter. That that breakout of that price is just about, at the quarter mark of the recovery. So that's going to be an automatic entry. You could have either a 1 day or the swing trade stop would be here because that's the actual collapsing dragon. And then if you got a collapsing dragon, you could expect it to fail to there pretty fast. So these are now the targets to the downside. And then the upside target would be far side of the river, SMA 30, PSAR flip of the RL10, peak of the RL90, peak of the RL10, the 30 period declining PSAR, and then the absolute high of the RL30. So that becomes my price ladder on the way up. That's my price ladder on the way down. That gives you a really favorable move. The um, and then the value says this is the best one. So anything on that list is approximately going to have that kind of a shape where you have a really clear, 10-day high, a significant sell off, a small enough doji that creates a very favorable reward to risk in both directions. And then I just frame it in the same way. Now, this one's interesting because XLP was kind of the middle of the pack of the S&P 500. So this is not in a panic mode. So that's an example of the swing trade 1 day at a time looking for tomorrow. Check or hold.
you. Yeah.
Check.
Thank you.
The other
Thank you.
stats in that table just give you, this the range stat, the size of the frog box, um, that kind of stuff. The maximum divided by the SD, that says the largest move of the last 30 days was 6 1/3 frog boxes. So that's the kind of a breakout move it could be. When it breaks out of a little doji, that could move 6 times 30, that could move $2.40. The max, and that again, the day of that maximum range was $2.50. So if it breaks out of 45, it could go, or out of 85, excuse me, it could go all the way up here to the SMA 30 in one day. That's how tightly compressed it is. And the fact that it didn't fail on Friday when the market failed,
Mhm.
what happens to a sector spider when the S&P goes up? So that's what makes that an intriguing candidate for trade. And everything that's on that list is going to have that kind of a setup. So if
Mhm.
you like that setup, that's a pretty good way to find 5 or 6 things to look at for tomorrow in one little page on the salad bar. So SLV on Thursday night, SLV was the swing frame of the day. It was in the top position, just like we saw XLP. And what it did on Friday was this. Excuse me. Oh, let's see. Yeah. Here. So this was the close on Friday. This is 10-minute charts. This was the last 30 minutes of Friday. It gapped down to here, and then it gave me the opening range 10 minutes right here.
Ken, that's a great trade, but I was going to ask you if you could frame it from Thursday because it actually was a swing trade candidate for Thursday with an opening above the high of Wednesday, and I entered long with a daily stop, and I was stopped out, and I saw that day, the next day, I saw that you traded intraday against that
Right.
daily breakout.
Yeah. Yeah. The reason is if the daily breakout fails, it's a failed swing trade. Yeah. Let me find the chart for here.
So the mechanical entry was giving the framing was done on Wednesday. The mechanical entry I took was on Thursday long
Yeah.
with a daily stop, and you traded Thursday
Yeah. I
intraday
think I
against
went
that.
long on, I went long on that. It stopped and then I reversed. Let's see. Daily. Yep. Yep. So this was
There was a doji on Wednesday, I think.
yeah, that was this.
Yep, very
Yeah,
promising one.
doji, and then
Yeah. And then the
Thursday it
10-day
opened
high was
up
still here.
right.
And so the fact that it had so far to go to here was something like 4 or 5 or 6 to 1 or something like that. And so then you set this frame up. So what I ended up doing that day was go long here.
Uh huh.
Then intraday it started failing. So I exit that trade and go short. This was a really good trade on Thursday intraday. And then this was enough to also make it the swing frame of the day. And it ended up going short, as you're about to see here. So the fact that it's in this tightly compressed state where it's so close to the break point right there, it's in an extreme condition. So if this trade works, it can go here. If this trade fails, it's going to come and test this. And if that breaks, it's a big move that way. So you got to see this as a really tight band of uncertainty. And as a trader, when it breaks out, you have to follow that rule, but it's supposed to go hard. If it doesn't, it's at least going to come back inside of this. Now, the two ways to have played that breakout is to buy it with your stop down here, and then it doesn't exit until Friday, I think. Although I think it may have
It
bottomed you out
exited.
on Thursday. I think it
Yeah,
bottomed
it
out on
exited
Thursday.
out at the
Yeah.
last tick on
And so
Thursday.
that would be,
I
yeah. So
yeah,
that's like well, that's actually a good thing because that's a -1 loss,
right.
but it protected you against this short. But then And so my point is there's about three ways that you can trade this thing. One of them is pure mechanical. I buy that with a stop here, and if it hits it, I'm out for -1. Or I can hybrid trade that. If I can play it mechanically, or I could play it intraday only and say, look, that one I know is in a compound critical state, and all I'm going to do is go to the 10-minute bars and trade it. And then near the end of the day, I'll make a decision if I want to hold it in the direction of the swing. So why would you do that? Well, you'd say is, look, here's the daily frame. And if I do turbo first, I could say, like it did, hey, it opened here. If it's still above that line by the end of the day, then I'm willing to hold that long. But because it's in this compressed state and it gapped outside of the yellow zone, I'll put a bracket on it. And that thing ended up being a really nice intraday trade. So if it did that and the next day it breaks down below, I don't want to be holding that long. So I'll trade it turbo intraday. And then if this thing had been in here and kept, hey, if it had just broken out from here, I still end up getting the long off of the R10 or R5 breakout. And then if this just keeps going up, I can sell 80% of my position, the turbo position. I can cash that 80% and put some money in the bank. And that money that was in the bank, I'm starting to get lag, sorry, pays for the overnight risk of the 20% of the position that's going forward. So that's if I'm just, that would be a hybrid style. So I could trade this either as only mechanical because I'm just doing end of day and I'm not available during the day. And if that's the case, you got long on Wednesday, stopped on Thursday, short on Friday. And you got about a 2.5 hour on Friday. Or I could trade it purely intraday and just say, I have a target that is likely to be an explosive move in either or both directions intraday. And I'm going to trade it with an OR10 breakout or that R10 bracket if it was a big gap. And I'm going to be flat before the close. So that would be purely intraday. A hybrid says, I'm going to start it off as a hybrid. And then if it closes in the direction, if it closes outside of the yellow zone, I'm going to keep a portion. I should be in that direction already. I'll just keep that position as a swing trade paid for with market's money from intraday. So those are the three ways I look at trading that it can be traded. I typically do it as that middle ground, the hybrid. I like to use my intraday trades to set up. So I'm getting close to time here. Uh, so the blue box is the last 30 minutes. The green box was the OR10. The red dot is the breakdown. The standard risk was up to the VWAP, and that's like what's that? That's about 30 cents. That's about 0.5%. Uh, After this little consolidation, the next leg down, I put a second position on. Write it down to the RL10 reverses. I take a 1-2 exit when it hits the spine of the dragon. That's about 6R. That's the argument for why the intraday move might be worth your attention, why these candidates might be worth your attention as a quick list of actionable items the next day. The regular sniper frame of the day for me was oil. And that was, again, blue box was the last 30 minutes. The pink box or that orangish box was a gap down to the yellow dot, which was the gap opening. I took a 1-2-3 exit long with a standard risk box. second position when it crossed the PSAR, exit on a 70% keep, caught a 2 re-entry, 1, 2, 3 entry, keep 70%, standard work.
Great trades.
No overnight risk. 10-minute charts. That's a quick look at the market 150 we've seen. Market 30, 30-minute, same, we've seen. We've seen all of this stuff before. All of the overreaction symbols fire. So this is a perfect long, that's how uncomfortable that one makes you. It automatically buys at the open tomorrow. Holy smokes. This is the holding X day period. This is how, comparing the performance of the last 1, 5, 10, 20, and 40 days compares to a 10-year historical performances of those same time periods. The worst Z score is the 40, and that's a -1 Z, but everything is kind of weak and terrible. Now, these are the Z scores of some of the other representative targets. Energy is great. Devon Energy is great. Alcoa is great. Intel, interestingly, is above average. So you start thinking about sneaky tech leaders. I wonder what Intel looks like. Yeah, it has not been painful. Yeah, it's sold off some, but the last 10 days have been up rather than down.
Sorry, this is IBM one more down.
I would be short that one at yesterday's close, but I would be long that out of that doji. If the market if this is a big gap down and the market starts recovering, Intel's going to lead tech north. I'll bet you out of the semiconductors. That is
So
poised to be
you
a
have
really interesting trade. There's no volatility in Intel.
you got IBM on the screen, Ken.
I'm sorry. Oh, wow. Oh, Intel's even better. IBM is interesting. But yeah, Intel has resisted the sell-off. It's even better than IBM. Look at that. It's above the 90 is above the 270. The RL10 is rising above the 270. SMA sideways. That's a pretty good chart right there if tomorrow is a tech good day, that's a good 1 day trade only. But I'm not holding anything overnight in a sideways volatile market in a war with Orange Man speaking. No way. The only things I have are the ones that are already long with markets money with their trailing stops paid for.
Mhm.
All right, that's where I want to kind of leave it there if I can. Yeah, the rest is kind of Goldman Sachs getting slaughtered. There's lots of things that are in the buy on dip and the auto framer, so it's a buyer's market. All of that red on the right hand side are ETFs that broke below the bottom of the previous look back period. So diamonds, Mexico, Brazil, S&P, everything slaughtered. Auto framer galore, target markets everywhere. So much to choose from. This little piece right here is that I kind of concentrated on the swing trades 1 day at a time, that the swing frame of the day. That's where that's coming from
Mhm.
based on this sort. And you can see just on the auto framer, they also tend to be the ones that are strong in the auto framer anyway. but it also includes something like how abnormally compressed was the compression. That's what makes this super compressed. That's what you want. Like the ones that are green and green and at the top of this stack, that's the ones you want. Okay.
Thank you very
Let's
much, Ken. Thank you, Alex.
let me see. Let me get two more here. I guess maybe I can get through it real quick. Just see if there's anything. The auto framer in TC2000, we've seen all that before. This is the MACD Four Seasons, obviously winter and all that red. Multi-time from NDX, the big red storm is crushing everything. So I use that to help differentiate where things are. This is that frog list trading value, no surprises. Yeah. The percent stretch away from the S, it's more than 2 sigma away. It's really accelerating to the downside. And this one, I remembered I wanted to show this one. Yeah, this volatility, that's what makes it volatile. Here's the average. Here's plus or minus 1, so it's volatile. This is the statistical slope of the S&P. It's at a starting to be really troublesome. Like here's where this is that last 10 years. It's right at Z minus 0.5. When it gets to Z1, Z minus 1, there in the last 10 years, there's only been 5 big that was COVID somewhere in here. So yeah, this is like walking on a frozen lake in the springtime. You can hear that ice cracking. You haven't fallen through yet, but man, you would be well advised to be paying attention. Let's see here. Yeah, this combines that z-score slope, the risk Z histogram, and then the red and the green lines on that one is just the daily drag as the daily river. Sorry, I'm gonna show that one. Yeah, the one I like the one on the bottom. It kind of simplifies everything. That's the RL10 swimming through the 30-day river. That says to me that says a lot. Once you kind of digest and internalize the previous 39 charts, or however many it was, that gives you location and relative volatility with the risk C. And then the z-score slope. The top chart shows the z-scores of the 10, 30, and 90, where they are, and everything's pointing down. I find that to be a very useful. That's why that's the last chart I look at and walk away. That's the one that is the one that's top of mind about the market as I think about tomorrow. So I started off with the wide view, drilled all the way down through the daily. Then as I leave the daily, the last thing that's in my head is that remember sideways volatile, risk Z horrible, Z scores of all the RLs pointing down outside of the river and failing. And then I can tell by inspection if that last little drop down to about 650 fails, 630, which is all the way back at the left side of the chart. So there we are. And time, 9 o'clock.
Thank you very much.
All righty.
Ken, thank
Appreciate
you very
you.
much.
Appreciate you. Let me run upstairs and throw my shoes on. Let's see.
Thank you, Ken. Thank you, Louis.
Yep, you're very
Thank
welcome.
you. Thank you both.
When I go to split screen again, it's hard to find where I pause and stop recording.